Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Each week here, we focus on a topic of interest to business owners, entrepreneurs, and real estate people. If you'd like to know the topic and guest each week, you're invited to sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today our topic is office investment opportunities. Please welcome Casey Kitchen, VP, National Office Group at Bull Realty. Casey, thanks for joining us today.
Thanks, Michael. Good to be here.
Also, please welcome John Davidson, Southeast Regional Director, Parmenter Realty Partners. John, thanks for joining us.
Thanks, Michael. Good to be back.
Well, gentlemen, we've heard Dan Fasula's view on the investment market. Let's look at the office sector from a market participant view. John, what do you see for cap rate trends on some of the properties that you work in?
Well, I can tell you, cap rates back at the bottom of the market in 2010 were at about 8.8%. They're at 5.8% now, which is an incredible movement. And I think that there is still some room for compression, believe it or not. And there's certainly room for, income growth. Rental rates have really not moved as far as they should have. So, and debt is really driving the whole thing.
Yeah, that's interesting. Casey, what do you see for cap rate trends?
I'm seeing cap rates in the markets I work, primarily in the Sun Belt, for the nicer product, Class A, mid-sevens, probably around 7.6 or so. And then for Class B or suburban, mid-eights.
Okay. And John, at Parmenter, you guys are always looking for Class A and Class B properties. With this slow recovery, are you able to find enough product right now?
It's tough. I mean, there's more buyers out there than I think I've ever seen in my career, and so when there are good deals, we're not the only ones that have found them. There's also more groups like us that like value add, that like deals that they can add some value to the building physically. So in the past that used to differentiate us, but it doesn't really anymore.
Okay. Casey, what do you see for demand for office properties?
There's definitely more buyers than there is product. We've seen a significant increase in the number of buyers jumping back into the pool or forming new funds. Just in the past 12 months, we've seen about 700 new funds or buyers enter the market, and this is for $2.5 million and above office properties throughout the U.S. So that number is approaching, the all-time high for the number of active buyers. So there's definitely more buyers than there is product available.
All right. Well, Casey, what do you expect for cap rates and investor demand through the year end and into 2014?
Personally, I think cap rates for the nicer product will stay pretty flat. There might be some compression. I think the cap rates for the suburban and value add type product is going to compress significantly, just because that's where all the activity is going, because they're priced out of the core deals.
Mm-hmm. And John, what do you expect to see for cap rates moving forward? Crystal ball look here. We got a crystal ball here.
Yeah, I think that there's still some continued strengthening, as I said earlier, and again, that's driven by debt as much as anything else, and competition. That trend, I think, will have to start dissipating soon, and as interest rates are, almost inevitably going to go up, it'll have an effect on cap rates.
Okay. And it seems like it's a real good time to sell stabilized properties where, you've got your occupancy up, you've got your rates up to market, and consider selling when there's all this demand in the marketplace from all over the world to buy office properties in the U.S. You guys have been active sellers, haven't you?
Yeah, I couldn't agree more. We've sold 4 assets this year, and have 1 under contract currently. So it has been a good time to sell. It's still a challenging market out there, but again, the debt is really competitive right now, and that's what I think is moving prices up to the range we want to see them in as a seller.
Yeah,
okay.
the availability of debt's definitely fanning the fire, in the investment arena, particularly CMBS loans that are readily available, even for suburban and value add properties. And the CMBS world is more concerned about cash flow than they are location or tenant quality. So that's adding to that flight to the suburban markets and value add properties.
Well, John, since you have some recent experience in selling these types of assets, what tips would you have for other sellers that want to sell products?
I think I wouldn't be too worried about vacancy if I was a seller in if you're in a solid market. The funds that are out there are looking for value add, and they'll actually price that vacancy up maybe more than you're going to realize if you lease it yourself. So it's not a bad time to get out there if you're in a solid market. I mean, if you're in a weak market with a lot of vacancy, you're probably going to get creamed because the buyers that are out there are pretty savvy and they're looking for good deals.
Yeah, well, that's quite a change, isn't it, Casey, that people give you good value for your vacancy?
Oh yeah, completely. I mean, just from 12 months ago when vacancy was heavily discounted, and now, as John said, they're pricing in some rent growth in that vacancy, and that's pushing pricing.
Okay, because the vacancy is just opportunity now, right?
Exactly.
That's right. And you may not be able to realize that same opportunity yourself. And
Yeah.
the people always think they can do better than where the market is.
Right. Yeah, that's interesting. So the buyers are figuring they can get better rents and better management and let them do it, right?
The glass is half full.
All right, stay tuned for more office investment opportunities. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. You're invited to check out Commercial Real Estate Show TV. That's right, I said TV. Well, it's video. Just visit YouTube and search for the channel Commercial Real Estate Show. Our topic today is office investment opportunities. We're talking with Casey Kitchen with Bull Realty and John Davidson with Parmenter Realty Partners. And Casey, we ended this segment with some tips for sellers who considered selling office. What do you have for them?
Well, other than the obvious one of calling me to help them out,
1-800-Casey.
I think I see a lot of, especially the larger sellers, engaging the very large brokerage companies. They're under the impression that it needs to have a very narrow marketing to a list of usual suspects, and I think it behooves most of the sellers to consider broadening who the property is presented to. And include some of those funds that are newly formed or some of the foreign entities that are jumping into the pool. If they don't see the opportunity, they're not going to bid on the opportunity. So, you still want to not just show the property to everybody. You don't want to cast the net too wide, but you need to you need to cast a pretty wide net if you want to really drive value and get more offers than is typical.
That's a good point. It comes down to supply and demand, right? I mean, we sold an office building to a foreign user. And we found out that before we've had the opportunity to sell it, that some other brokers in the marketplace weren't getting it out there. This buyer was out in the marketplace, didn't know about it. And this buyer paid more than the investors in the market would have. So I think that's a good point.
Yeah, that happens all the time. You'd be surprised how frequently that happens. I mean, it's usually the guy that will pay the most is not necessarily who you would think would be the obvious buyer.
Yeah, that's a good point. Well, John, where do you see opportunities in 2014?
Well, just as you guys were discussing, there's a lot of buyers out there, so we're having to look a little bit off the beaten path. We're looking at some of the second-tier markets and kind of beating the bushes right now in the suburban markets, which have been passed over a little bit, looking for infill opportunities, some of the same kind of dynamics that we like about CBD markets, the second-tier CBDs. We're trying to find replicated in the suburban markets.
Okay. And one of the things that we keep hearing about office users is they're using less square footage per employee these days. John, what do you see there, and how's that affecting the office market?
Yeah, in 2010, you were at about 225 feet per employee. Now you're at about 176, and we're projected to be at 151 feet per employee in 2017, which is just remarkable. It definitely is having a chilling effect on expansions, and it's also had a chilling effect on future development. We think the trend is likely to kind of, I don't know if it gets all the way down to 156 because there is some repercussions to that. It's having putting a lot of pressure on the parking at buildings. There's anecdotal evidence that the employees aren't really liked being crammed in, privacy issues, etc. So I'm not sure how far that plays out. I think the other thing that's driven it is the amount of tenant build out incentives that are in the market, and allowing existing tenants to basically reconfigure their space. And as those incentives dry out from landlords, some of those, total rehab of their spaces is not going to be viable.
Yeah, that's interesting. I had a guest a few weeks ago that mentioned that one of the backlashes from less square footage per employee is health. That we get into the winter months, and you've got people sneezing on people or whatever, and so you can lose some productivity. Have you heard anything like that from any of your tenants? Or?
I mean, I'm not surprised.
Yeah.
We've walked into some of our spaces that have had this happen, and you really can't believe that it's the same tenant, where they've maybe consolidated, where they had three or four different buildings, and they've moved them all into one of our buildings, and you just can't believe the number of tenants that are in there.
Yeah.
Or employees, rather.
I think those smaller square footage occupancies, they're more conducive to some sectors versus others. If it's a creative company or a technology company, that's going to fit 100 square feet a person. But, if it's a law firm, I think the ones that have tried that are probably, some of them are already wondering what they did and if they should have done that. You know?
Or a radio show. Look how we're crammed in here.
Well, a brokerage firm too. I mean, that I don't think we would be as as productive as we are if we had common areas and everybody was talking over each other. And
but people can always escape to their home and work from their iPad and their cell phone, and so there is always a plan B out there. Which is
at the end of the day, they still need an office, right? So we want to keep our
forever
jobs
and
here,
ever,
John.
yeah.
Okay.
I've done that. It just my dog will start barking right when I'm on a big call.
That's exactly right.
I don't think I've had a conference call where the dog hasn't been somebody's dog barking somewhere.
All right. Well, another question I have for you, John. When you're talking to business leaders and these tenants about their growth plans, do they mention anything about Obamacare and debt ceiling debates? Are some of them more reluctant to grow, or is it just business as usual out there?
It's certainly not business as usual, but I think in spite of what's happening in Washington, most of the businesses we talk to are I don't want to say optimistic, but they're universally growing and growing modestly. There's no doubt that the government has put challenges on the economy that don't need to be there. And the uncertainty of Obamacare has been a real frustration for almost every business.
Okay, so they're actually saying that when you're talking to them, that's one of their fears, their uncertainty, the unknowns of Obamacare?
It's an additional cost that you can't get your arms around, and so it's hard to, particularly when you have the companies that are right around that 50 employee mark, do they want to grow, and how are they going to manage that growth? Do they split off into separate companies? There's a number of new considerations that companies didn't have in the past. So
you think there's some pent-up demand for office space out there if this uncertainty it's lifted a little bit?
Well, we hope so, but I mean, who knows? Today, we're ready for anything, I guess would be the thing to say. Yeah, well, some of the tenants I talk to and people who run businesses, I think there is some pent-up demand, and I think if some of this uncertainty gets lifted, we could have a robust economy right ahead of us. This is Michael Bull. This is the Commercial Real Estate Show, and we'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. You're invited to connect with us on Facebook, LinkedIn, Google+, and Twitter. You can find them all at commercialrealestateshow.com. Well, today we're talking about the office investment market and opportunities out there with Casey Kitchen with Bull Realty and John Davidson with Parmenter Realty Partners. And John, I'd like to ask you about sustainability. With all the cutting cost out there of tenants and landlords to make properties profitable, has sustainability taken a back seat? Is going green still popular? It probably has taken a bit of a hit. It certainly hasn't with us. We have an internal group that does LEED certifications, and you certainly don't get tenants to pay for it. Tenants never were paying for sustainability. They all talk a good game, but if you want to tell them that your building's going to cost 25 cents a foot more because you're green and you're LEED certified, you're going to have a long conversation with yourself because they don't really want to hear it. But It is a very important thing to do, and we find that we can cut costs, and you get a return in your expenses.
Yeah. Okay. And what about a recent transaction? Can you share a recent transaction with us, John, that might be interesting to the listeners?
Well, I've been more of a seller than a buyer this year, but we have a deal up in Nashville under contract that, interestingly, we bought in August of 2008. And we're actually going to make a profit selling that asset.
Wow.
We were able to, renew some tenants in that market, and the market has done great. Nashville is a fantastic market. We saw that when we went into Nashville. I don't think that it probably has recovered as much as it's going to, so I think the buyer's getting a great deal too, because Nashville is going to be a really hot market in the Southeast.
Well, that's a great story. I don't know if any of our longtime listeners would think that would happen. You could buy a building in 2008 and sell today and make a profit.
We actually had some of the pricing adjustment was already happening in August of 2008. I mean, to a certain extent, people remember what happened in October as being, sudden and a real surprise. But we could see the writing on the wall, and so we had taken the pricing down before we closed. It was really, I guess, good execution as much as anything else, keeping the tenants that we needed to keep and bringing in some new ones.
Well, good for you. Casey, can you share a recent transaction with us?
A number I'm working on right now actually involve deals that were bought at the bottom of the market, 2009, 2010, highly distressed deals, vacant or sub 50% occupancy. And either those folks that bought those notes and foreclosed added some value, and now they're looking to sell them as stabilized assets, or some of them are fortunate enough that they just bought at the right time when nobody else is willing to buy, and they haven't really done anything with them, but they're selling them into an improving economy, and they'll sell them at 60, 70% occupancy as a quote value add deal with some upside. But as John and I talked about earlier, off camera, a lot of times there's not a lot of meat left on the bone for those deals, so those deals are somewhat challenging to pencil out.
So give us the price per square foot that note buyer bought a recent transaction for a few years ago, and what they're selling for.
You're looking at a 2010 note purchase price with a clear avenue to title at about $40 a square foot. Wow. And that asset now is it's going to trade at $65 a foot. And that's with basically no increase in occupancy whatsoever or rates or anything. It was somewhat of a zombie building bought by an opportunistic buyer, and now they're going to sell it to a value add buyer.
Yeah. Okay, well, gentlemen, thanks for joining us today. We appreciate it.
Thank you.
Thank you.
Well, if you'd like more information from Casey or John, you can visit Parmco, PARMCO.com, or you can get Casey at bullrealty.com. Next week, we'll have an interesting look at the retail market, so be sure and join us. The retail market has been very interesting. It's been the trailing sector, and there's also opportunities there around the country. So thanks for joining us today. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by your friends at Bull Realty, France Media, Atlanta Office Liquidators, and Wiseman, Nowak, Curry, and Wilco. For more information about these companies or to access additional show podcasts, videos, or blogs, visit commercialrealestateshow.com.